Welcome to the Explainer. If you're gearing up to buy a house, you've probably slammed headfirst into this massive wall of alphabet soup. PMI, MIP, MPI. I mean, it literally sounds like some secret code designed just to confuse you into paying more, right? Well, today, we are enthusiastically untangling all these acronyms. The goal for this explainer is super simple. We're going to break down exactly what these terms mean, what they're going to cost you, and most importantly, how you can actually use them strategically to your financial advantage. Okay, let's dive right into this. Here is our roadmap for the explainer. First, we're decoding PMI versus MIP. Then, we'll calculate the real-world costs. In Section 3, we're going to flip the script and look at mortgage insurance as a strategic buying tool. Section 4 covers the escape plan, basically how to legally drop these fees. And finally, we'll wrap up by talking about protecting the borrower. Section 1, decoding PMI versus MIP. Clearing up these acronyms is absolutely the crucial first step to truly understanding your mortgage options.
Let's kick things off with PMI, which stands for Private Mortgage Insurance. Now, here is the biggest misconception buyers have. They constantly think this insurance is for them. It's not. No way. PMI is strictly an insurance policy that protects your lender if you happen to default on your loan. If you suddenly stop making payments, PMI does not prevent you from facing foreclosure, and it certainly doesn't save your credit score from taking a huge hit. It is literally just a risk mitigation tool for the bank.
So how exactly does PMI compare to MIP, or mortgage insurance premium? Well, PMI is tied to conventional loans, and its cost, that heavily depends on two big things: your credit score and how much cash you're putting down. The better your credit and the closer your down payment is to 20%, the less you pay. Simple. MIP, on the flip side, is exclusively for FHA loans. And unlike conventional PMI, the FHA's MIP does not factor in your credit score at all. Seriously, whether your score is 580 or a perfect 800, your MIP rate remains exactly the same.
Section 2, calculating the costs. Let's take these abstract acronyms and translate them into actual dollars and cents so we can see how they really impact your monthly budget. All right, if you go the FHA route, you are hit with an upfront mortgage insurance premium right out of the gate. As of 2024, this upfront premium is 1.75% of your total loan amount. Now, don't panic. You usually don't have to bring that cash to the closing table. It's almost always rolled directly into your loan balance. But just to put that into perspective, on a $500,000 loan, that's an extra $8,750 tacked straight onto your principal.
Now, what's really interesting about this slide is how the FHA dynamically structures your ongoing monthly payments, your annual MIP. It's dictated completely by your down payment percentage all your loan term. Look at this. If you put down more than 10% on a 30-year loan, your MIP factor is 0.50%, and the insurance drops off after 11 years. But if you put down less than 5%, which, let's be real, is super common for FHA buyers, your factor jumps up to 0.55%, and you are paying that for the entire life of the loan. Though, if you opt for a 15-year term and put down more than 10%, that factor drops way down to just 0.15% for those 11 years.
Switching gears back to conventional loans for a second, your annual PMI costs generally range anywhere from 0.58% to 1.86% of your loan amount. Since this isn't some flat government rate, it relies entirely on your personal financial profile. If you've got a lower credit score and you put down a minimal amount, say around 3%, you're absolutely going to find yourself on the much higher end of that spectrum. Section 3, a strategic buying tool. We're turning a perceived penalty into a distinct financial advantage here. So there is this massive myth in real estate, and we need to address it head on. Is mortgage insurance only for first-time buyers? A lot of people just assume that once you sell your starter home, you'll take that equity, drop a clean 20% on your next house, and avoid MI forever. But in reality, savvy, experienced move-up buyers intentionally use mortgage insurance all the time. Let's tell a quick story to really anchor this math. Meet Sarah and Barry. They have $90,000 in cash from selling their first place, and they want to buy a $375,000 fixer-upper. If they put down a full 20%, which is $75,000, sure, they avoid PMI, but they only have $15,000 left over for a new kitchen, flooring, and all those bathroom updates. That is a seriously tight budget. But if they strategically choose to put down just 10% and take on the mortgage insurance, they retained $52,500 in liquid cash. Yes, their monthly payment is slightly higher, but they actually have the cash flow to make the house their dream home. Let's zoom out a bit. because this builds into a much broader strategy. Retaining that liquid cash provides incredible flexibility. You aren't just limited to home renovations here. You could use that retained cash to completely wipe out high-interest credit card debt, boost your kid's college fund or your retirement savings, pad your emergency rainy day fund, or even expand your overall buying power. Like by accepting MI and putting down 15% instead of 20%, you might actually be able to afford a larger home in a significantly better school district. It is all about preserving your financial options. Section 4, the escape plan. How to legally get rid of your mortgage insurance. So the crucial point is, once you're strategically using MI, you've got to know exactly how to legally stop paying it. Okay, for conventional loans, the rules of the escape plan are governed by the Homeowners Protection Act of 1998. The HPA lays out the exact federal conditions for terminating your borrower-paid PMI. It's incredibly important to note that this law applies strictly to single-family primary residences. It does not apply to lender-paid MI, it doesn't apply to investment properties, and it absolutely does not apply to FHA loans. Under the HPA, the magic cancellation number is 80%. When your loan principal reaches 80% of your home's original appraised value, meaning you've legitimately built up 20% equity, you have the legal right to submit a formal written request to your servicer to cancel your PMI. But hey, what if you completely forget to ask? Well, you're in luck. The law has a built-in safety net at 78%. When your loan-to-value ratio is scheduled to naturally hit 78% based on your original amortization schedule, your mortgage servicer is legally mandated to automatically terminate your PMI. You literally don't even have to lift a finger for this one to kick in. Now, if you want to be proactive and actually submit that request at 80%, you must follow a few specific steps. Obviously, you got to reach that 80% loan-to-value mark. But you also must have an acceptable payment history, so 0 late payments. You cannot have any subordinate liens, like a second mortgage, hanging around on the property. And finally, the request to your servicer has to be in writing. But wait, what if your home has just skyrocketed in value? You don't necessarily have to wait to pay down the principal. You can use a new appraisal. However, the investors behind the scenes, like Fannie Mae and Freddie Mac, have slightly stricter rules here. First, you must have a 2-year seasoning period. After that, if your loan is under 5 years old, your new appraisal must show a 75% loan-to-value ratio to cancel the PMI. If your loan is over 5 years old, the threshold softens back to 80% LTV based on that new appraised value. Now, escaping FHA MIP, that is a much tougher game. If you put down more than 10% initially, you just have to wait it out. It drops off automatically after 11 years. But if you put down less than 10%, that mortgage insurance premium is bolted onto your loan for life. The only realistic escape plan there is to refinance entirely out of the FHA loan once you have enough equity. One tiny silver lining, though, if you're refinancing an FHA loan into a new FHA Streamline loan, you might actually be eligible for a partial refund of that massive upfront mortgage insurance premium you paid at the very beginning. Section 5. Protecting the borrower. Let's look at a stark contrast with mortgage protection insurance. So we've spent this entire explainer talking about insurance that protects the bank. Now let's flip it and look at mortgage protection insurance, or MPI. Unlike PMI or MIP, which remember will still leave you facing foreclosure if you can't pay, MPI actually steps in to protect your family. In the event of a negative health change, an injury, illness, or premature death, an MPI policy pays out to take care of your mortgage balance or your monthly payments. And this brilliantly illustrates the difference between getting this coverage directly from your mortgage lender versus an individual insurance provider. Look, if you buy MPI through your bank, the bank is the beneficiary, not your family. Furthermore, as your loan balance drops over time, the bank's coverage decreases, even though you are paying the exact same premium. But with individual MPI, you maintain total control. You choose the beneficiary, so your family can spend the money how they see fit. The coverage amount stays beautifully constant regardless of your loan balance. And because it is fully underwritten right at the start, you avoid any nasty surprises if your family ever has to file a claim. At the end of the day, securing your own MPI roots these highly abstract financial concepts back to the real human impact. It's about emotional and financial security. It provides this profound peace of mind knowing that if the absolute worst were to happen, your home is totally secure and your family is taken care of, rather than just protecting some lender's bottom line. Wow, we have covered a massive amount of ground today, completely untangling the whole PMI, MIP, and MPI alphabet soup. You now understand the real costs, the strategic advantages, and your exact legal escape routes. So I want to leave you with this final provocative thought to consider as you review your own financial setup. Knowing that you can leverage these tools to retain your cash or protect your loved ones, which mortgage insurance strategy actually aligns with your long-term homeownership goals? Thanks so much for joining me on this explainer. Keep learning, and I will see you next time.